It was early morning in Europe. Screens were on. Coffee was still warm. Charts were calm, almost boring. Euro CHF had barely moved for years. A flat line, a dead pair. Many traders didn't even look at it anymore. And that was exactly why it killed them. On January 15, 2015, in less than a minute, the Swiss National Bank erased thousands of trading accounts. Not slowly, not painfully, but instantly. No warning, no second chance, no mercy. Some traders lost their entire account. Others lost more than their account. They woke up owing their broker money. Debts they never imagined were possible from a single trade. What happened that day wasn't just a market move. It was a moment that exposed something deeply uncomfortable about trading, something most retail traders don't want to face. Because the SNB shock wasn't a black swan. It was a reminder of who actually controls the game. I still remember where I was that morning. I wasn't trading Euro CHF, but I was watching the screens when the candles started exploding. Not moving, exploding. Spreads blew out, prices skipped, charts looked broken. And then the messages started coming in. Friends, traders, people I knew from forums and Skype groups. Some asking what happened, some asking if the price was real, some not asking anything at all, just silent. That silence is something you never forget. Because silence in trading usually means only one thing. Someone just lost more than they can process. At the time, Euro CHF had been pegged at 120 for over 3 years. The Swiss National Bank had promised to defend that level with unlimited force. Unlimited. Retail traders believed that word. Brokers marketed it. Funds built strategies around it. And thousands of traders quietly parked their money there, thinking they had found something rare in markets: certainty. It felt safe. Too safe. People sold volatility. They added size. They removed stop losses. Some even treated Euro CHF like a savings account. After all, how could a central bank lie? That belief that markets can be made safe by authority was the first crack in the foundation. And when the SNB removed the peg without warning, that crack became a collapse. In seconds, Euro CHF dropped nearly 30%. Liquidity vanished. Orders didn't fill. Stops didn't exist. And what traders thought was risk-free turned out to be pure leverage stacked on top of blind trust. This wasn't just a price shock, it was a psychological one. Because for many traders that day, destroyed an illusion they didn't even know they were living inside. The illusion that if something hasn't hurt you yet, it can't hurt you at all. The illusion that authority equals safety. The illusion that risk only exists where volatility is visible. The SNB shock didn't just kill accounts, it killed a mindset. And the most disturbing part? Most of the traders who died that day weren't reckless gamblers. They weren't chasing breakouts. They weren't over-trading. They were patient. They were conservative. They were doing what they believed was the smart thing. That's why this story still matters, because the market doesn't punish recklessness alone. Sometimes it punishes misplaced trust. And if you've been trading long enough, you know this truth is far more dangerous than any chart pattern.
The mistake that killed those traders didn't happen on January 15, 2015. It happened quietly, months earlier, when they stopped asking hard questions. Euro CHF looked like a gift: low volatility, tight range, central bank support. For retail traders, it felt like the rare moment when the market finally played fair. But markets don't reward comfort. They punish complacency. The core mistake wasn't leverage, although leverage amplified the damage. It wasn't even the lack of stop losses, although that sealed many fates. The real mistake was confusing stability with safety. Retail traders saw a flat chart and assumed risk was gone. They saw a central bank promise and assumed rules had changed. They saw years of defense at 1.20 and assumed the future would look like the past. That's how the mind works under prolonged calm. It normalizes danger. When volatility disappears, traders don't reduce risk, they increase it, slowly, rationally, convincingly. A little more size, a little less margin buffer, a little more confidence, until one day the floor drops out. When the SNB removed the peg, Euro CHF didn't move through prices, it jumped over them. There was no market in between, no buyers, no sellers, only empty space. Stops didn't fail because brokers were evil, they failed because there was no liquidity to fill them. This is the part most traders don't understand until it's too late. Risk is not defined by your stop loss, it's defined by liquidity. And when liquidity vanishes, your risk becomes unlimited. That day, many traders didn't just lose their account balance, they went negative. They received margin calls after the fact, debts they never agreed to consciously, losses that exceeded everything they thought was possible. That kind of pain changes people. Some quit trading forever. Some blamed brokers. Some blamed manipulation. Some blamed themselves. But very few actually understood what really happened. Because the market didn't break, it did exactly what it was designed to do. It exposed the weakest assumptions in the system. And for retail traders, the weakest assumption was this: that someone else was responsible for protecting them. The revelation doesn't come during the crash. It comes after, when the noise fades and the questions get quieter. For many traders, the SNB shock was the first time they realized something deeply unsettling. Markets do not owe you continuity. They do not owe you liquidity. They do not owe you fairness. Central banks are not guardians. They are players with their own priorities, constraints, and breaking points. The SNB removed the peg because defending it had become too expensive, and when the cost outweighed the benefit, the promise disappeared. That's the moment traders should have understood a brutal truth. Every guarantee in markets is conditional. Liquidity is conditional. Support is conditional. Safety is conditional. Once you see this, you can't unsee it. The SNB shock wasn't about Euro CHF. It was about leverage sitting on top of blind trust. It was about risk being hidden, not eliminated. And the traders who survived, the ones who stayed in the game, didn't survive because they predicted the shock. They survived because they were structured for the unknown. They assumed things could break. They assumed prices could gap. They assumed authorities could change their mind. That assumption, uncomfortable as it is what separates professionals from victims. The market doesn't reward intelligence, it rewards humility. And January 15, 2015 was the day humility was forced upon everyone who thought the market had become safe.
To really understand why the SNB shock was so devastating, you have to step away from charts and look at the market as a system, not a price. Most retail traders think risk lives in volatility, fast candles, big wicks, violent moves. But the SNB shock proved something far more dangerous. The most lethal risk hides inside calm markets. Euro-Swiss franc was calm because volatility had been artificially suppressed. The peg acted like a lid on a boiling pot, and when you trap pressure for long enough, the release is never gentle. Here's the mechanism retail traders missed. For 3 years, the Swiss National Bank stood as the only real buyer at 1.20. Not a natural market participant, a policy decision. That meant liquidity below 1.20 wasn't being tested. It wasn't being refreshed. It was decaying. Banks, funds, and brokers adjusted their behavior around that artificial floor. They stopped making markets where they didn't need to. Why provide bids below 1.20 when a central bank was doing the heavy lifting? So over time, the order book didn't become deeper, it became hollow. From the outside, the chart looked stable. Underneath, the structure was fragile. This is what professionals call liquidity illusion. Prices don't move, so traders assume depth exists. But depth only exists if participants are willing to trade. And when a single player dominates the market, everyone else steps back. On January 15th, when the SNB stepped away, there was no natural demand waiting underneath. No gradual repricing, just air. That's why Euro-Swiss franc didn't fall, it collapsed. Now here's the part most retail traders never connect. Leverage doesn't create risk, it exposes it. For years, traders were rewarded for increasing size. Selling volatility paid. Carry trades worked. Nothing punished the behavior, until suddenly, everything did. The SNB shock wasn't random. It was the inevitable outcome of a market where risk had been hidden instead of removed. And the smartest players understood this long before retail did. Large institutions didn't need to predict the exact timing. They just needed to understand where risk was accumulating. Some reduced exposure. Some stopped trading the pair entirely. Some widened internal risk models because they knew one thing retail didn't. Central bank credibility has a breaking point. Let me be very clear here. This wasn't insider trading. It wasn't conspiracy. It was structural awareness. Professionals don't ask, will this break? They ask, what happens if it does? Retail traders asked the wrong question for 3 years. How do I profit from this stability? The right question was, what is the cost if this assumption fails? And when it failed, the cost was catastrophic. This is why stop losses didn't save people. Stops are instructions, not guarantees. They only work when there's someone on the other side willing to take your trade. Liquidity is the real stop loss, and when liquidity disappears, protection disappears with it. The SNB shock is the purest example of a market truth that still applies today. Risk is not visible when it is being priced out. It becomes visible only when it returns all at once. That's why similar patterns keep repeating. Long-term capital management in 1998, the volatility blow-up in 2018, FTX in 2022. Different markets, same structure. Artificial stability, crowded positioning, hidden leverage, sudden withdrawal of support, and then collapse. If you want to survive markets long-term, this is the insight you cannot afford to ignore. Whenever you hear the words, "This is safe now," you should start looking for the exit.
If the SNB shock taught us anything practical, it's this. Survival in trading has very little to do with prediction and everything to do with structure. Most retail traders ask, where will price go? Professionals ask, what breaks if I'm wrong? That single shift in thinking changes everything. The first principle is simple but uncomfortable. Never build a position that depends on a promise. Not a central bank, not a broker, not a historical pattern. If your trade only works because they won't let it happen, then the trade is already broken. Markets don't respect intentions, they only respect incentives. The second principle is about exposure, not entries. Retail traders obsess over timing, but timing is meaningless when size is wrong. If one position can erase years of progress, the problem is not volatility, it's allocation. Professionals survive shocks because no single assumption is allowed to threaten their existence. They don't trade to be right, they trade to stay alive. The third principle is understanding where liquidity actually lives. Flat charts don't mean safety, they often mean neglect. When a market stops moving for too long, ask yourself who is still participating and who has quietly stepped away. If liquidity is being propped up by one dominant force, that is not stability, that is dependency. And dependency always carries an expiration date. Finally, accept this truth fully. Stop losses are not shields, they are requests. They work only when the market can honor them. So the real question is not where your stop is placed, but whether the market will still exist when it's needed. If you internalize these principles, you don't need to fear shocks like SNB 2015. You don't need to predict them, you just need to make sure they cannot destroy you. That's the quiet discipline that separates traders who disappear from those who are still here 10, 15, 20 years later. The SNB shock of 2015 didn't kill traders because it was violent. It killed them because it exposed a lie they had been living with for years. The lie that safety can be outsourced. The lie that authority equals protection. The lie that calm markets are harmless. Markets don't punish ignorance immediately. They let it grow, and then one day they collect everything at once. If this story made you uncomfortable, that's a good sign. Discomfort is where real learning begins. Because trading is not about finding certainty in an uncertain world. It's about learning how to move through uncertainty without being destroyed by it. If you want to stay in this game long enough to matter, you have to master that skill first, before strategy, before setups, before indicators. Master yourself. Then, and only then, can you begin to master the markets. If this perspective resonates with you, subscribe to Staro Trading. This channel is not about hype, signals, or shortcuts. It's about understanding how markets actually work and how traders actually survive. And before you go, leave a comment and tell me this. What assumption about the market do you no longer trust?